Okay.
Yeah.
So we'll start there then. So you started in commercial real estate when you were 17 years old working for your
17
brother.
years old. Yep. I was a runner for my brother.
And
at
so you were
17.
just running paperwork, I assume?
I was making floor plans, fact sheets, opening buildings, just
Yeah.
helping my older brother who was an industrial leasing agent. And then at age 18, I went off on my own
Okay.
and started as an industrial leasing agent at age 18.
So then you went on, did you start doing office after you came back from the mission, or how did that?
So went on a mission, continued to do industrial for, for 2, 3, 4 years.
Yeah.
And then around age 24, age 25, I transitioned to do investment sales.
What made you do that transition?
I was always fascinated by it. I
Yeah.
thought it was cool. I thought that I wanted to understand I didn't want to only understand the leasing side of things, but really from start to finish. And so I went and obtained my CCIM
Yep.
back in the day so that I could understand the investment side of it. And then at age 25, I quit doing anything else besides just investment sales, but I did investment sales along the way up until that point in time.
And were you investment sales through all assets, like office, industrial, multi?
At first, yes.
Okay.
The Salt Lake's market really has expanded significantly and grown significantly. But back in the day, you couldn't be an investment specialist and only do one product type.
There wasn't enough stuff. Yeah.
No, there wasn't. And so then as the market started to develop out, I started doing office sales, a lot of them, and started making that more of a focus.
Was there a reason that you went towards the office? Was it just kind of a blue ocean and you thought that you could kind of make your niche over there?
Fair question. I don't remember why.
Yeah. Just,
Because I'd never leased any of it. I didn't understand the market as well.
yeah.
I think it was because I met a guy by the name of Wayne Ballou, and he had an office portfolio. And I said, hey, we can sell that on the market. And he said, okay, let's try. And so he gave me the listing, and so I tried.
Yeah.
And
One day
we
you
were
just wake up
successful
and
and
you
could just
start selling office.
Start selling office.
Yeah.
And then from after that, of course, I became a student of the market to understand it really well, so that I could sell a lot of that product and advise properly on it
Yeah.
along the way.
So when did you go from commerce to NAI?
When I was 24, 25 years old,
Okay.
Mike Falk and Zach Anderson and Kyle Roberts and Steve Condi and I were the 5 guys that started NAI Utah, which is now Newmark,
Yep.
Grub, Acres, I think they call it.
Yep.
And so at age 25, I went off and did that.
Okay. And just investment sales the entire time. And then at what point did you join CBRE?
I joined CBRE I was there for 13, almost 14 years, and I left in 2022. So whatever the math is
Yeah.
in there.
Yep.
Yeah.
Just a little bit of time. And on the phone call earlier today, you said that you left to go to CBRE because of the platform.
Yeah.
What kind of drew you over there? Was it like the nationwide data, the relationships?
Good question. So I am a God-fearing man, and frankly, I just felt inspired. Like, hey, look into CBRE. If we were really going to go into like the story behind everything, I would tell you usually it starts with I feel inspired to look into something or to do something, and then that draws to whatever I end up doing. I one day was driving home with my family from Bear Lake, and had all the kids in the car. We're towing the boat home from having fun together, and the thought just came, hey, look into CBRE. So I did, and when I saw their platform, I was like, holy cow, I'm an investment guy, and this platform is so phenomenal that I could do some real damage with this platform. And so because of that, I sold my stock at NAI Utah and went to CBRE to be on the capital market side.
And you mentioned also on that phone call that you started going heavy into multifamily because you found a gap in the market.
Yeah. So I can't remember which year it was, but 5, 6, 7 years now, I noticed that Equimark closed their doors. And Equimark, up until that point, had been like the dominant force. And they were hard to compete with. And I hadn't even sold multifamily, hadn't touched it. And so when I saw them close their doors, the very next day, CBRE was having a multifamily convention in Chicago. I called my wife, said, hey, honey, I'm going to start doing multifamily. I need to be in Chicago tomorrow morning, okay? And so went and bought flights. And then
she
went
was
to
just cool with it? She was like, go for it.
She's used to being married to me,
Oh, that's
so
good.
she was cool with it. And so I started doing multifamily then because when you're the dominant broker in a market and you sell something to someone, if they don't resell it through you, it's it doesn't look good.
Yeah.
You don't get more looks if you do
Yeah,
that.
I
And
think the easiest way to get a bunch of deals in your inbox is just to say, if you sell it to me, then I'll let you sell it on the backside.
yep, and most will do that, right? And so
Yeah.
I knew there were a lot of jump balls that were about to come. And I thought, okay, now's the time. Let's go into this marketplace. And then I also noticed that the market does not have really good multifamily data, and the brokers especially didn't have good multifamily data. And so we went in and looked at where there were holes in the market as far as the data was concerned, and became the dominant force in multifamily data. That was something Equimark actually did quite well when they were in existence, but they'd kind of started to falter a little bit in that front, and we brought it back in full force and actually put it on steroids and made it to where if someone read our report or sat down with us, they would understand the market cold.
Do you think, was it due to Utah being a non-disclosure state, or was it like they weren't tracking rents, lease up, velocity?
Yeah, good question. A little bit of all of that, right? First off, Equimark was the dominant force. They had stopped, and their reports weren't there, and so we realized, okay, this is going to leave a bigger hole than just brokerage. And then the size of our market. You know, the big national the big national groups that do data, we weren't as big of a market as some of the markets they were tracking, and so they weren't tracking our market well. That has improved over the years, but they still don't track a number of things in a way that we want to know and understand to make decisions, and that our clients needed to know and understand to make decisions. And so we hired a full-time multifamily researcher, and that's all he did. And we were constantly saying, okay, but can you tell me this? No? Okay, well, can you tell me this? We got to a point where like we tracked every single lease up every single month of every single property. And then once you have 3 or 4 years of data, you can actually predict the future with pretty good, you can never predict the future, but if you want a crystal ball, if you have past data, and we said, okay, holding all things constant, let's assume absorption stays the same based on the pipeline and what's coming and when it's coming, we could tell you quarter by quarter how much was coming, what absorption would do, and what we thought vacancy would do. So we were really starting to get into projecting the future off of it.
I think that is some of the most valuable information of just supply, real estate supply and demand. And if I've read your guys' report over the years, and it's like you had every single project that was coming online in the next like 3 years. And so that was,
and there's really good data out there, and so but it was a matter of taking what wasn't there and creating it and doing it in a way where you had good data that people could invest off of.
Yep.
And so in advising on that, the market was very, very receptive to it.
And you said that you were kind of the one who brought a lot of these institutions into the Valley over the years.
Yeah.
And how did those conversations go? Did you just meet them at the CBRE multifamily conference in Chicago and said, hey, you should really check out Salt Lake? Or?
That's pretty funny. So I've been going to those conferences. I was in brokerage for 30 years. So I've been going to those conferences for 30 years. It used to be, by the way, 20 years ago, I would go to those conferences and you'd meet some guy at the obligatory cocktail hour, and then they say, hey, where are you from? I say, oh, I'm from Salt Lake. They'd look at you and say, oh, that's nice. And then look to the next guy and say, hey, where are you from?
Yeah,
right.
like,
And
is
so
that a part of Nebraska?
yeah, exactly. They didn't, where is that again? However, the last 5 to 7 years of my career, I'd be in an elevator. I'd start talking to someone and they say, oh, you're from Salt Lake City? I've been looking for you.
Yeah.
I've been told to come into your market and buy.
Yeah.
And so you got to help me get into your marketplace. So now we are on the map. A lot of institutions want to be here. So over the years, I met different institutions, and frankly, over time, you build a reputation so they know who to look to. And so number one, I was at CBRE. So a lot of groups that were buying from CBRE around the country would then come and say, let's talk to your Salt Lake guy. And then other than that, it was groups just looking to come in and they'd see who had product. And so we did a lot of Google tours where we do an hour Google tour with a big institution.
Yeah.
Then we do it with another. So we were the first to help CalSTRS buy in this market. And they did it through another group. So at first we were working with their sponsor, and then they came into town. We helped Israeli groups come into our market to start with. We helped Principal Financial, MetLife, Starwood. The list goes on. There's quite a few of them, but it was always, if you give them really good data so that they can actually go to their investment committee and look intelligent and have the right types of answers, then they were going to look to you for what they needed for brokerage.
This is kind of I guess, random question, but like, let's say a pension fund is listening to the show and they're like, I want to get in Salt Lake City. Like, how would you recommend that they try and enter a market? Do you just start cold calling brokers that are doing deals, or what's like the most strategic approach for that?
Yeah, good question. So, first off, get all the data you can, and then find those that not only have the data but then know how to digest it,
Hmm.
and find the right brokers in that market space that really have become experts, and then they'll kind of guide you through it, right?
Yeah.
And so that's something that we had a lot of where they just people came and wanted to understand the market, what it looked like. So
Yeah.
I'd find the two or three best experts, then really talk to them and understand and start to build up a story behind the market.
Cool. Um, and so you had this fantastic, you were living every broker's dream. Like you had this big pipeline, people trusted you, you'd sell them something, and then you would sell it for them on the back end. And you said, I'm actually going to leave that. Why did you
Yeah,
do that?
yeah, that's a great question. Again, um, I am I trust the God of heaven. I know the God of heaven. I pray, He answers me, right?
Yep.
And so one day I actually had an opportunity. So I was talking to Christian Gardner, and he said, "Hey, do you want to come over and be our chief investment officer?" And I was about to tell him no. And then I started praying about it, and I thought, actually, we should do something different. What I felt like is that there was an opportunity not only to be a part of the large pipeline that Gardner Company has, but then also to open some other companies alongside that
Hmm.
that would help others raise capital around the country. And so we're under the process of doing that, or in the process of doing that. But the Gardner Company, I loved what I saw. I knew them reputationally, and then a little bit over the years, and sold I don't know, $200 or $300 worth of product for them over
Just
the
a
years. So a little
small
bit of
amount.
stuff
Yeah.
over the years for them, but they have a pipeline of $4 to $5 billion. We own 1,500 to 2,000 acres now. So I went to Gardner Company. I'm the chief investment officer there, and so it was exciting to be a part of that, but then also to open up some other things along the way that I think the market will be very receptive to.
Yeah. So was it just that quick? It was like, hey, do you want to join? And then 2 weeks later, or
It was one week actually.
no?
We never
Whoa.
talked about this on the phone. So
Wow.
yeah, it was actually quicker than that. So again, I prayed about it. Felt like I was going to say no. Then I felt like no, actually, you should do it. And not only should you do it, but open up another company
Yeah.
next to it. And so I saw that opportunity there, and it was 5 days from the time Christian and I spoke to the time I
Wow.
told him I was coming. I think it started like Wednesday, and then the following Monday I said, I'm coming. I'll be there in a week. And so it was quick. It was very, very
Wow.
quick.
I I gotta say I respect that because a lot of people talk about it and they never take action. And
It's either crazy or you call it what you will, but it was the right decision. Was really pleased with it. Being at Gardner Company has been fantastic. Like
yeah.
Kem Gardner, the chairman, and Christian's been running the company for a long time as a CEO, has given hundreds of millions of dollars to charity. He's in the office often. He's been on many boards, and he loves the community. He loves to do things. And Christian, we're not only at a company that, yes, we're making, our goal is to make money and make good developments, but we're really trying to change the communities and bless and help the communities. So like Christian started a company called R Plus, which is a renewable energy company, but on the like high utility scale. So you're giving tons and tons of power to the grid. We have 35 to 40 projects around the country. And he started that company in, I think it was 2018. So it's not that old of a company, but
Yeah.
has made a big impact and will make a much larger impact. And then Christian also, again, he really cares about the environment. And so we built the first large scale mass timber. There's other mass timber buildings, but this is the
Hmm.
first large scale, 150,000 square foot mass timber office building called Ballsky Point.
Is Pelly on there?
Yeah,
I was in there last
Paleon's
week.
corporate headquarters. Cool
Yeah.
building, isn't it?
It's sweet.
Isn't it
So
just
yeah.
fantastic? And so when they decided to build that, they started building it before I got there, but it was because Christian felt like, hey, if we start the mass timber trend in Utah, that will make a difference. That will help our clean air, and that will take embodied carbon and not have as much carbon used by each time you're building buildings, and that the market would be receptive to it. And so it's fun to be at a company where they care about the community and what's going on and making a difference.
What do you think the goals are of the company? Like, obviously they want to make money, but
Mhm.
is it delivering high quality products or is it making communities better through development? Like, how do you think of that aspect of it?
Yeah, good question. So it's a number of things. Yes, you have to make money on a project or you won't build it,
Yeah.
and so that's given. Um, so we care about the environment, we care about people, we care about how our projects make people feel, and How do they feel when they're coming home? We're starting to build multifamily. And when you're in an office, how do you feel when you're in an office? And is it the type of atmosphere where you can be creative and you can do the types of things that, that have a high quality of life for people? We're trying to figure out right now some different ways to put for sale product on the market, because there's not enough for sale product for
Agreed.
for younger, smaller families wanting to start out.
Yep.
And so we'll probably partner with some people just to put that product on the market, not because we're trying to make money, but because we actually think there's ways to put more product on the market at a lower price point, which then, is a real blessing to these smaller families and people starting out as they build their families.
I'd love to help. You let me know how I can. And so on the office conversation,
Yeah.
Gardner's obviously built a lot of office over the years. You've sold a lot of office.
Yep.
Where do you think we are in the office market today?
Yeah, that's a great question. So it's a dumpster fire right now, right?
You could say that.
It's an absolute dumpster fire across the country. Right?
Yeah.
There's so it's kind of interesting. You can draw a parallel between retail and office, right? 7-8 years ago, retail was a dumpster fire, but it's because the actual kind of, how would I say this, the underlying demand of retail changed because Amazon came to the world, and other sources like Amazon, where all of a sudden you don't have to leave your house to buy everything. You can order it online. And it'll come right to your house, and you can do it with an app, and it's so simple, right? I love it. I'm a huge Amazon fan. I buy a ton from them. But that changed the dynamic of retail. And 7 or 8 years ago, that took retail and turned it on its head and made a lot of changes occurred. But then everyone stopped building. And then, however, demand continued, and then they realized, wait a minute, there's still a very big demand for retail and for sticks and bricks, but it's where is it, what is it, how is it? And some old retail centers were converted to multifamily or industrial or something else. So then your supply is going down, yet the demand's still there. And now retail's at what, a 3.3% vacancy?
Pretty good.
And so it's pretty awesome.
Yeah.
It's not healthy if you're a tenant looking for space. It's great if you're a landlord, right?
Yeah.
But that then will cause vacancy to, when vacancy's that low, the lease rates are going to start to grow.
Yep.
Same thing will happen in office. There was a fundamental shift. And I think it was an overcorrection, because I was at a ULI event yesterday, and in this event there were 15-ish people there, and they were all in their 20s. And I said, by raise of hand, how many of you here are better at your job and with the company you're with? How many of you are better if you're actually in the office interacting with people on a day-to-day basis? Every one of them shot their hand up.
Yep.
And so companies are figuring that out. Companies know that. And so there's still a demand for office. It's just a smaller demand than it was before. Certain aspects of the office market are going to struggle, while others will do well. So you're going to see vacancies start to go back down. And then eventually I think you're going to have a very low vacancy rate, and it's going to be, there's going to be a big demand to build. And then all of a sudden the basics of office will start to improve significantly.
Yeah.
It's pretty painful today, though.
Yeah, it is very painful today.
Yeah.
I will be the proud owner of my first office building next week. So,
Congratulations.
Thank you. So I'm buying the bottom, I think. So, you guys aren't actively buying office, right? Do you guys ever buy existing assets?
So yeah, good question. Most of the time, no. We're developers. If there's the right opportunity, we do look at it. And because what we really are people that understand real estate and cycles and what's going on. And so we have looked at some existing real estate, and we'll continue to. If it's an opportunity where we just think, with where we are in the cycle and with where costs are right now to rebuild, we can buy this and be in a better position.
Well, that's the thing with office right now is it's like it's for sale or lease, and the price is $18 a foot regardless. So maybe not in Utah, but in other markets. And so,
that's pretty funny.
I mean, I gotta say,
buy it for $18 a square foot, or
someone help us, please. But
it'll get better.
I think so. So, on the retail subject, you said it's it'll come back. The demand will. Where is it? What does it do? Like those types of questions. What do you think that looks like for office specifically? Is it smaller floor plates? Is it more urban, more suburban? What do you think that looks like?
Yeah, good question. I think that we'll see where that comes out, right? Right now, downtown is struggling, and many downtowns are struggling. So a lot of the suburban office is actually doing better than the downtown office. And we'll see how that plays out. In our own market, Silicon Slopes is a very hot place to be.
Yep.
And the reason is you have the largest employee base there, right?
Mm-hmm.
If you're anywhere from Sandy to Lehigh, you can pull from all of Utah County and all of Salt Lake County. That is the biggest employment base in the entire state of Utah. So it's not that hard to figure out why that area does so well from an office standpoint. And so you'll see a lot of that area strengthen again because it was the hottest part of the market before. It will be again. It will grow and be strong there. Keep in mind a lot of the better office buildings are still in the low to mid 90s from an occupancy standpoint.
Yep.
So the nicer the building, the better it suits what tenants are looking for. While things are soft out there, it will get better faster for those types of assets.
The divergence in office is like fascinating to me because
Yeah.
you'll see buildings sell for $1 a square foot in St. Louis, and then you'll see other buildings record-breaking leases, and I'm like, something's not adding up here. So,
Yeah.
okay, so what exactly does a chief investment officer do? Like, are you just chair of the IC? Are you making long-term strategic decisions? Like, what does your day-to-day look like?
Yeah, good question. So I do a number of things. So yes, I chair the investment committee and oversee the investment committee. And any asset that we look at, we have an investment committee. We get together. We look at the deal, and it's presented by one of the development teams. And so we'll look at that and determine if we think it's something we should invest our money in, both our money and then LP equity. And
Yep.
so in the past, the Gardner company self-funded everything. So when
Which
I
is
came over,
insane
which is
to me.
crazy, right?
Crazy.
It's crazy, but they did.
Yeah.
And so now our portfolio is so big. Again, we own 1,500 to 2,000 acres. We can build 8,000 multifamily units. We can build, I can't remember how many, but 7 to 10 million square feet of industrial. We can just do an awful lot with all the land that we own.
Do you want to carve off like a little piece for me? I think that'd be awesome.
Right. I hear you there. I hear you there.
Yeah.
And so my other job, and it's one of my primary responsibilities, is to go out and raise the right LP equity for our deals. And so and that's a fundamental shift for the Gardner company, but one that we're breaking ground right now on a 400,000 square foot industrial deal up in Ogden. We're bringing in LP equity. And quite frankly, if you're a developer and you use LP equity and you do a good job and you hit your promote, your returns are phenomenal. You can get really strong returns.
Yes.
And so that's the other thing we're looking at is, okay, on each of these deals, if we're going to bring in 90% of the equity, first off, can we do what we say we're going to do and get the type of returns that we're projecting here, and then hit the kind of promote that we want that would then helps us really juice our own yields.
Yep. And on the investment committee, how do those conversations typically go? Like, can you describe how that looks? Like, are there 6 of you, 7? Is it unanimous vote? Is it majority vote? How do those decisions typically go?
So it depends. There's usually 7 or 8 of us. Sometimes we'll invite others in depending upon what it is that's being looked at. So far, it's all been unanimous vote.
Yep.
Well, with a couple exceptions. Like
Yeah.
there may be someone who says, I don't agree with this one, but I'm going to, it's not,
I trust you guys or something.
I trust you guys, or this is not my deal. This is someone else's deal, or it's a different product type. So it's a different, development team that's overseeing it. But for the most part, it's, yeah, that works, and let's make it work. And so, but when it comes, we look at, by the time someone comes to investment committee, they understand the deals, they understand the number, they understand the risk, they understand the debt, they can come in and really present in a way where we can make decisions. The investment committee is not to, to shoot the bull. It's to come in, give all the right data, give all the right, determine what the risk profile is, and come in and help us understand the risk profile and what needs to happen there so that we can leave with the decision.
Yep. And when you said you're raising the right LP equity, so what does the right LP equity look like? Are you working with pension funds, family offices? Does it depend on the deal? How's that?
It depends on the deal. So if it's a project we want to keep long term, and by the way, we still have a very large portfolio that we've never sold, and so we have a lot of cash flow coming in from the existing portfolio. So it depends on the deal. If it is a deal that we want to keep long term, then we're going to go after family office money. There are some institutions that want to hold long term, and so, but family office money. The deal that we're doing up in Ogden is a long term family office deal. It's family office out of Seattle, and they almost never sell.
Yeah,
it's strong cash flow. We like it. They're happy with it, and so it's one where we're crystallizing the promote very quickly, and then just going into a cash flow model.
That's beautiful.
Yeah, yeah.
What?
But then we have a number of others where, yeah, it's a 3 to 5 year hold. It's a churn and burn. We build it, we sell it, and on something like that, then that's going to be more high octane money.
Yep.
That's going to be money that's coming from an institution or a fund or someone that they have a 3 to 5 year model. We have a 3 to 5 year model. It works well, and so it just depends on the project.
How do you decide which ones you want to hold forever versus the ones you want to sell? Is it
Some locations are so prime, you're just like, we're never selling this thing.
yeah,
Right?
exactly.
Also, what kind of cash flow can you pull off? If you
Yep.
can have really strong cash flow that then, helps the company continue for many decades because you have a lot of really good cash flow properties that work. So it depends deal by deal.
Yeah.
And some of them, you're just better off, building it and selling it and moving on.
Yeah, they
Depends.
always say like the richest guys in your neighborhood are the ones that sold a little bit too soon. Like,
Yeah, that's right. Yep.
okay. And how do you typically structure those? Are they all just common equity and like a 8% pref and an 80/20 or like some format of that, some variation?
Yeah, every deal's a little different, but typically you're going to have a pref between 7 and 9%.
Yep.
And so you're pari pursue. So we'll always put at least 10% of the cash in. Sometimes we'll do more. The one in Ogden we're doing right now, we're doing 20% of the cash. So on different deals, we'll put in some money and then they will, and then our money is pari pursue.
Yep.
So we both get the same return. But then once we get above a certain threshold, the waterfall kicks in.
Yep.
And so from, let's say it's a 9%, first hurdle, and then between 9 and 12%, you were at pari pursue, and now 70% goes to the GP side of it,
Mm-hmm.
or the equity side, and then the other 30% then goes to the developer as a
Yep.
kicker. Right, and it just, there's a lot of different models, and everyone's a little different. And so when we go out to raise equity, we'll talk to the different groups, and they'll come and say, here's our term sheet, here's what it looks like.
Yeah.
And then there's always development fees in there as well. So
Yep.
we'll get development fees, which is also nice for a firm to be getting the fees along the way as well.
It is nice.
Yeah, yeah.
Okay. And on the equity side, so that was kind of where you spent a lot of your time at CBRE, raising LP equity. I'm going to ask some selfish questions. If I want to transition my business into, whether it's family and friends or high net worth individuals, and I want to start going after institutional money, if you were me, how would you do that?
Yeah, good question. So I would first look at what do you think they're going to want to understand, and then make a pitch deck. But that pitch deck should have all of the key things you think they're going to want to see, so that they can just sit there and say, okay, I get it, checks the box. And then always be, and I'm sure you would be, but always be really open and honest. Here are the risks. Here's how we think we're mitigating them, but they're the risks. So here's the risk profile, so that they know that, so that there's no surprises, right?
Mm-hmm.
I usually, if there's a skeleton in the closet, it's not in the closet for long, man. We disclose it quick,
Yeah.
right? Just so that they know, so that they also know that anytime you do something with them, they can trust you, and they can trust that you understand what you're doing, and that you're going to be very transparent. And then put that pitch deck together, and from their perspective, and show them what their returns will look like and what their risk profile is, and then go out and just openly talk to them and see where things are, see how they kind of lay out with them.
How should I get in contact with these people? Do I just start firing off DMs on LinkedIn, or like what's the best strategy?
That's
for
a
this?
great question. I've been working on contact lists for years, right?
Yeah.
So we're going to go out to for LP Equity actually this week on this one is a 5-building, 500,000 square foot project that we're buying 31 acres of industrial ground at a really good price in the Northwest Quadrant, and we're building it that will fit where the tightest part of the market is.
Yep.
So we're going out on that right now. That's why I was a little bit late, because I was working on that.
No,
I thought
it's
I've got to
okay.
get that done tonight
Yeah.
before I go.
That is a little
so-
bit more important than the podcast.
No.
Hey,
When you commit, you commit,
Yeah.
right? I'm delighted to be here, but that's what I was working on before I came, and so you head out to those groups. By the way, that is also one of the reasons why we're opening up another company alongside Gardner, because I get that same question you just asked, not just from people like you, but think about it. I'm at one of the largest developers in the state of Utah, and I was brought on to do just that.
Mm-hmm.
And so I said to him, guys, this isn't a local problem. This is a national problem. And so if someone really masters the middle market fundraising, and can then go out and do this for other developers and other people like us, there's a huge market there if someone does it right.
It is a massive market.
It is.
There's very inefficient. The $5 to $20 million equity checks. It is really hard.
Knowing the right people, who are they? How do you communicate with them? How do you get to them? What do they want to see? How do you do that efficiently? And so that's, again, one of the reasons why we're opening up another company here next year, to do that nationally. Quite frankly, to do it for third parties, you have to be a broker-dealer. So
you're studying
Series 7, Series 24, Series 63, creating a broker-dealer, and then a platform that can efficiently go to the market quickly on it.
Where do you see that going? Is that like something that you would IPO or something, or is it like just in the Gardner portfolio with you?
Yeah, good question. We'll find out.
Yeah.
I don't know. It's been fun and exciting and hard to build it.
Yeah.
It's not built yet. You have to get a lot of. It'll be an SEC regulated company, and so we're going through all the hoops to become SEC regulated and FINRA members, and that's not an easy gig.
Not easy
But
at all.
I hear that same question from you from many people, large and small. Even the largest development companies in the country are trying to figure out how to raise equity, and their people are out doing it all the time. So I hear it not just from groups my size or your size, but it's all the way up the chain of size.
Well, I'm excited to see you tackle that because I could use that help. Okay, and on the phone earlier, we were talking about you've got $2 billion or $4 billion of pipeline in the next couple of years, and you are studying what makes sense and what does not make sense. And we were talking about the data earlier. How are you looking at that, and what makes you want to go forward today?
Yeah, so it's a deal-by-deal basis.
Yep.
So we underwrote about $2 billion of potential deals within our pipeline over the last 2 years. And not much of it made sense. But if you think about it, we're in the part of the market cycle where we're in a recession. And in recessions, vacancies go up, interest rates go up, it's harder to buy, cap rates go up, everything's going up. And so a lot of value has been lost from the peak of 2022 until now. But when that's happening, everyone's looking at deals and saying, wait a minute, if I'm an LP investor or a developer, right, without someone else's money, even if it's just our money, and we can develop it to a 6, but the market cap rate's a 5.75, that's 25 basis points. We're not building, man.
Yeah.
We have to have at least 150 basis point spread between today's cap rate and what we can build it for. So if today's cap rate's a 6, we need to build it for a 7.5. And so unless we have that spread, it doesn't make sense. And so we just sat there and watched the market going down, and you're underwriting all these deals saying, wait a minute, cap rates just went up 100 basis points. This still makes no sense. In fact, we only had 150 basis point spread to begin with.
Yeah.
Like, who would touch this? And so we have certain deals right now that because we either have a very low cost basis on the ground, because when you own a lot of ground, you've had it and your basis is low. So we have a lot of land at a very low basis. And so there are specific deals that we're building based off of where we are. The land that we're going to go out on with this new project at 31 acres, we're getting it at $620 a square foot in a market where that's just that's killer. But that makes up for a lot of problems, right?
Yeah, it does.
And so our yield to cost on that one, or return on cost on that one, is going to be a 7.2 untrended. And so if you're at a 7.2 untrended and the market's at a 5.75, you've just got your spread there, right? You have enough spread there, and then you also expect the rents to go up, and so by the time you trend it, you're going to be in a good spot. Yeah. And so so that deal made sense, but all of the others that didn't, it's kind of funny. You and I were talking about this. I said to our analysts, I said, hey, what do we have to do to make up this 100 basis points, right? So if before we could build it at a 5, now we have to build it at a 6. Or if before we could build it at a 6, now we have to build it at a 7. What do we have to do? And so they went and ran the numbers and came back and said, you have to either go, and it was kind of cool how it didn't matter which one it was. If the cost of construction went down by 15%, or the rents went up by 15%, or the combination of the two, it could be 7.5 and 7.5, we gained a 100 basis point spread. So we would go from a 6% cap rate to a 7% cap rate by increasing rents by 15% or reducing costs by 15%. So that all of a sudden gave us when we looked at that, we were like, okay, then now let's look at which of these projects can we do that on? Where can we build the lower cost product? Where can we increase rents, or where do we think rents will increase? And then all of a sudden you start to kind of hone in on what actually makes sense.
So are you trending those rents ever? Just saying, we're looking at supply, we're looking at demand, we're looking at absorption, and we think in 2 years rents are going to be here?
You can, but it's a hard story to raise capital on.
Yes.
So if you can do it untrended, what we found, and by the way, I talked to hundreds of LP investors, and so and I was constantly on the phone with them saying, what will you do? What will you accept? What works? What doesn't work, right? And what we were hearing was on multifamily, and we're still hearing this today, for those who will invest, who aren't just on the sidelines with pencils down, they're saying at a 6.5% return on cost, untrended for multifamily, we'll invest. Of course, we're going to trend our numbers. Of course, we expect rents to go back up. But rents for a while weren't going up.
Yeah.
And rents for, you know what I mean? And then if you really
Maybe
take
even
concessions,
down.
they were going down. Yeah, exactly.
Yeah.
And so who wants to invest on that, right?
We don't talk about rents going down on this podcast.
No.
They
Oh,
only go
so
up.
sorry.
Yeah.
You know, I should have.
It's okay.
I should have read the rules a little
Yeah.
closer before I came in.
It's
Man.
okay. Next
So,
time.
but if you look at that, so a 6.5% return on cost untrended,
Yep.
investors are in. 7% return on cost on industrial untrended,
Yep.
investors are in. So then we started to look at all of our assets and thought, okay, then if we're going to build something that we're not just going to fund ourselves, but we're going to have LP equity fund it, what deals can get there? How can they get there? What does land cost have to be? And so, and by the way, costs have been coming down. I know everyone says costs never come down. We
do talk about that on the podcast. Costs come down, but
Costs coming.
rents
That's
go up.
right. So we did on the project we're breaking ground on right now. Costs came down by $3 million. Right, and it's about a $50 million deal.
That's good. Yeah. 6%.
It's not bad.
Yeah.
Roughly, right? I mean, so, but the cost came down was the kicker. And then that allowed us to be above a 7% return on cost. And when we went out and actually hard bid it, we had subs that before wouldn't even bid our stuff. They were coming and saying, can we bid? We had multiple general contractors. So there's enough slowing going to where people are going to be hungrier and at least be, competitive.
I had a landscaper knock on my door the other day.
There you have it.
I was like, it's time to build. Like, the subs
That's
are
right.
hungry.
Yep.
So,
Yep.
would you ever do a deal as tight as like 100 basis points, or is it like hard and fast 150 basis point spread?
Yeah, fair question. I would say maybe.
If it's
Right.
in like
It
right location.
depends on the deal,
Yep.
right? It depends on the deal, right location. So if you had an investment grade tenant for 10 to 15 years and you knew it was a no-brainer and it was an easy deal
Mm-hmm.
and you knew that you had an easy out then or an easy exit, right? Because investment grade tenant long term in this market, that's valuable, right?
Yep.
And so maybe on something like that, but again, if you can get to 150 basis point spread between where you develop it. So again, if you develop it at a 7, if you can sell it at a 5.5, you're going to get a 20% levered internal rate of return over a 5-year hold. You're going to 2x your money. Those numbers work in today's market.
Yep.
They work in almost any market.
They should.
But they work
Yeah.
in today's market,
Yeah.
right? So then all of a sudden it makes sense.
Yeah. We actually had a question from the audience. If you were to start today, you're 30 years old.
Yeah.
What would you be doing? Would you be in brokerage or would you be in development?
Yeah.
Would you be in equity?
So I always looked at development and thought it was fascinating and thought it would be fun to get into it and admired the guys that were in it. But for me, I loved brokerage. It's because I worked 40-hour weeks.
Mhm.
I have 8 kids. I have 2 grandkids.
8?
One on the way. Yeah,
Wow.
8 kids. And so I was able to be a dad. I was
Mhm.
able to be home at 5:30 at night, and I didn't leave until 8 in the morning when they went to school. And so for me, the lifestyle of a broker was really nice. I could be to their games. I could be there with them. So I loved the lifestyle I had. And as a broker, you get to choose how much time you work. Now, there were times I needed to work more. I did it from 10 to midnight when they were asleep.
Yep.
So loved what I did then, and for me that was a really good way to go. And then what's funny is even now the company will open alongside Gardner Company. It's in the space I know. It was in the space where I've spent more than 10,000 hours. And so whatever you decide to do, focus on it, become the best at it, become an expert at it, and you can do a lot of things. You can make money anywhere. So what
Yep.
do you enjoy, right?
Mhm.
So I've enjoyed it, and I wouldn't change it.
Cool. Well, I want to bring this home. What do you think Utah looks like in 10 to 15 years? Because you've been in the real estate world for quite a while, and you've seen the culture shift and population grow. We've got potentially a baseball team. We now have the Olympics coming. What do you think Utah looks like 10, 15 years from now?
Yeah. So crystal balls are always hard, right?
Yep.
But I think much of the same growth that you've seen, you'll continue to see.
Mm-hmm.
And I've been watching this and been a part of bringing big investors to Utah for 30 years now. And that's not going to stop. We will have more and more capital. So I actually spoke at a CCIM event. I think it was the big symposium 5, 6, 7 years ago. And I said to everybody, I said, the owners of real estate today that you are working with, I said, watch how it changes. And since then, you've had Nuveen, you've had Starwood, you've had Principal Financial, you've had MetLife, you've had these big institutions come in. And there's some I'm missing, many I'm missing actually.
Yeah.
And so you're going to continue to see a market where there is more and more capital coming in, both institutional, big family offices, international. So you're going to see a lot of capital coming into the state of Utah that wasn't here before, which will help our market, grow even further. And then a lot of people moving in. Like there are a ton of people that have been moving in and they love it here. And when you talk to them, they're like, "Oh my heavens, this is the best place ever! Like the recreation's outstanding, and and so I don't see that changing anytime soon. And so you're going to see the population grow significantly, and see a lot of other things come."
I was touring with a institutional group out of Denver today, and we were driving north on 700 East, and he was like, "This is what people think Denver is like." Like when you land, you would think that like you're in Denver, but really you're in Salt Lake. So it's a better version. It's a better version of Denver. So
it's I used to kind of joke with people and say, this is Denver, but everything's an hour closer.
Exactly. Cool. This has been awesome. Thank you so much.
Oh, my pleasure.
So
Appreciate the time.
We'll get you back on to talk about the LP equity stuff whenever you want. So
sounds great. Let's talk mid to late next year.
Okay. Awesome.
Thanks, man. Appreciate it.